Hey everybody, welcome to the morning market briefing. It's Tuesday, January 13th, 2026. Huge show today. We got tons to talk about, everything from earnings to continued geopolitical development, small business optimism, and much, much more. But we got to start off with the most relevant topic coming through right now as we take a look at CPI. Tom, do we have the data?
The data just hit. And I'm a little surprised by it. I know Ben's pulling up the BLS data. I'm going to pull it up as well. But expectation for month-over-month CPI was 0.3. That came in at 0.3. Core CPI expectation, also 0.3, came in at 0.2. So the year-over-year number for headline CPI, 2.7, which was in line with expectations. But the core came in at 2.6. And so initial reaction, bond market hot right now.
I mean, Nick Timmeros of the Wall Street Journal actually tweeted something out earlier and actually had revised the estimate up.
Yeah, he had the core coming in at 2.8.
Yeah,
what he thought.
Core coming in at 2.8 and the month over month at 0.36. So the fact that we were at a rounded 0.2 versus an estimated rounded 0.4 is really significant. And Tom and I were talking about this before about why people were thinking and Wall Street was thinking that CPI would be as hot as these estimates indicated. Because if you actually looked at last month's, which was the November read, which of course we didn't get the October number, and there was a shelter component in there that would have added about 10 basis points. But even if you normalize all that out, we would have been at 0.16%, which are about 0.2% on a month over month. The estimate that the Cleveland Fed had was 0.2%. And all these Wall Street banks were coming out at 0.37, 0.43. There were some that were even higher than that. And so to come in at 0.2 on the month over month on the core is a really good news.
No one from Wall Street. Let's pause there real quick. No one from Wall Street. I mean, this is Bank of America, Barclays, Citigroup. No one had a core month over month number that would have rounded to 0.2. Everyone was 0.3, if not 0.4. Every single one of them.
A lot of the estimates had apparel really ramping up pretty significantly, and it was up 0.6% in the month of December, but that's far less than, I think some people had 1.7%. Bank of America might have had 1.7% on apparel.
I mean, the weird one to me is that utility gas service up 4.4% month over month after being down the previous three readings, which do not include October, November. So that's now running at a 12-month estimate of 10.8% for gas. Meanwhile, oil prices are cratering.
And natural gas prices are down a lot.
Yeah, so I think that one's a little bit of a
and shelter
scratcher.
And shelter reaccelerated to 0.4.
I mean, I still think that number's too high.
So we're at 3.2, and if you annualize that, you're talking 5%, which I don't think happened in December. I think that December was a little bit more stabilization in the housing market as people bought at the end of the year, feeling a little bit better after the government shutdown ended. But I don't think it was annualized 5% growth.
I mean, Ben's probably annoyed, but I spent a lot of time looking for evidence that the housing market is slowing and down, and I want to say it was either right after Christmas or after the first of the year. I found a really interesting analysis that showed that the only reason why, quote unquote, house prices are up in any measurable manner is if you stratify by housing price. Housing prices, everything under $1 million is cratering. You're talking, low single digit drops in prices, but everything over $1 million is accelerating, which,
so we blend that.
Yeah, so for every $1 million house that sells at a 10% increase, you're basically eliminating 3 houses in the $300,000 price range and netting that out. And so we talk about this K-shaped economy. You can't say that if really, really high priced houses are accelerating, but the rest of the housing market is coming down, that inflation, as it is felt by most people, is going up on shelter. I mean, it has to be known that the average house that someone would buy, call it somewhere, depending on where you live, between $200,000 and $500,000, the price is going down at a significant rate. I mean, most people don't live in $1 million houses. That's just the facts.
A big reason that and I completely agree with you, Tom. I think that this K-shaped economy, we'll talk a little bit about Delta in a little bit, what they're seeing with the K-shaped economy. But I think we're only accelerating. Meta has some news that kind of points to that today as well. You know, that you have the haves and the have-nots. What's really interesting in the CPI report, and I think a lot of the inflation is really coming through on the services side, because if you look at commodities, excluding food and energy, we had a grand total of how much price growth do you think last month?
0.
Indeed. And then, you know, this is with tariffs. And
so would you define that? Tim Rouse told us to look for somewhat firming readings.
And the thing is, Wall Street was exactly talking about that, because a big narrative of the last CPI report. So remember, the last CPI report was very low, and it was kind of poo-pooed both by
can't be right.
Yeah, exactly. Mainstream Wall Street economists, as well as people on the Fed. Beth Hammack of the Cleveland Fed actually talked about, say, take the CPI with a grain of salt, because there's some weirdness in the data. Well, a big point that they were making was that the survey was collected later in the month of November than normal because of the government shutdown. Therefore, it was taking into account Black Friday's discounts. Ergo, you know, you had lower inflation in November, but we're gonna have a lower comp in December, so you're gonna make up for that in December. Well, we're seeing 0% growth on the goods, and what's really interesting is if you look at appliances or furniture or other things like that. I mean, you go through the list, and we're seeing not inflation, we're seeing deflation. Major appliances down 4% month over month. Laundry equipment down 5%. So this is not what the economists expected. This supports that, hey, maybe the November data was a little bit more real than people initially thought. And I don't know, Tom, like, I don't know what bonds are doing right now, but I think they were dramatically mispriced before this. And I wouldn't be surprised if they're still, I mean, if we could see a sub-4 handle within a week.
Well, we haven't moved much. The initial reaction was much stronger. So at first, we were call it right at like a 420 on the 10-year. We dropped immediately to about a 415, and we've settled in right around a 417, which, stop me if you heard this before, is pretty much exactly where we've been for quite some time now. So I think people are still, they're very resistant to the idea that inflation is coming down. And I think that maybe they're a little caught off guard because they've been so dug in on it. But if rates aren't moving down today, I would say this is an opportunity. And long bonds continue to sell off. Everything 10 years and out is actually selling off. So, I mean, it's a pretty interesting move, I think.
I mean, I think the Fed's pretty much pre-committed what they're going to do, or rather not do, this month at their meeting, and they're not planning to cut rates. I think that the latest salvo, and we'll talk about this too, by Judge Jeanine against Powell, has kind of cemented that and further entrenched the Fed's positioning. So, but I mean, I just look at this, and on most categories, I can't really see the case. I mean, if you look at services excluding shelter, so this is kind of your core services, up 0.2%. And that's supposed to be the most inflationary. If you look at core goods, I mean, it's flat to down. So, I mean, on all of these metrics, I just don't see where the inflation is.
I mean, the gas thing makes no sense to me.
Yeah, I'm curious.
That's going to have an outsized impact. If that was in line with the rest, I mean, if you look at the rest of energy, which overall was down 0.4, gasoline down 0.5, fuel oil down 1.5, energy services at 1, so roughly flat, but that includes the utilities, electricity down. I mean, it's skewing the entire energy piece up so much.
Do we think this has any linkage to? I mean, we heard from President Trump last night pushing for reform on utility bills. I mean, is he a super user?
I think he is. I mean, he had the employment numbers.
He had that early.
So I think he probably had this early. But this is something that I don't know if we actually talked about it on the call, but we certainly talked about it internally. We knew he was going after defense, then he went after healthcare, and then he went after the insurance companies. And what's the next logical place for him to go is the credit card companies.
He did the $200 billion in purchases of bonds on mortgages.
And it was just a matter of time before he went after utilities. These are government-enabled entities that are a hot button issue because it's AI is making my air conditioning more expensive. That's the narrative. And it was only a matter of time before he cracks down on that.
And we're going to need that AC because we have the hottest country.
The rent-seeking behavior is getting cracked down on, and utilities are right there. And I think that this is, Trump's truth last night speaks to that.
Tom, you mentioned bond reaction this morning. We had a strong 10-year bond auction yesterday.
Yeah, I think it feels like right now there's a pretty hard cap in right around 420, and I think that's probably appropriate. I would say that's about as cheap as bonds should be right now, particularly given this kind of information on CPI. And so, I mean, it was, we started to tick up that direction, and then we got a massive auction. It was one of the lowest amounts, the direct bidders. So, highest amount of direct bidders since March 2014, the lowest amount that the dealers, so the investment banks, held on to because they're legally obligated to buy what's left over, and that was only about 5% of the auction. So huge demand. I think people understand there's a lot of value in the long bond right now. So I'm interested to see how the 30-year goes today because it's so much cheaper, and I think that's a real opportunity. I mean, I think that in choice areas, we even bought some yesterday. I bought some 2052s yesterday at $4.95 with the lower coupon, which is maybe less desirable. But if we're going to see numbers like this, CPI coming down at a rate that people were not expecting, then you're going to see the 30-year bonds start to pull in closer to the 10-year bond, which will give you an outsized convexity play. So you could see very large gains there. And we've seen it walk back a little bit. So, we've talked about buying long bonds. We've done a lot of it. Those are mostly flat, X the coupon. But if we see a big convexity move, we see the 30-year come down, we're going to be riding that wave in a big way.
I mean, the duration, just for clients or people who are listening in terms of what the impact is that on a price level. And normal, we're buying bonds for the income. But it's also a nice hedge. For example, if we had a big deflationary move and rates went down, it's nice to have a piece of the portfolio that's winning in that category. If you had a 100 basis point move on a 30-year bond, the math, and it's just a math equation, the math means you're going to be up 20% on that bond. So when do rates fall really, really badly? Tends to be when you have a big growth scare and stocks fall. So it's really nice to have a piece of the portfolio be up 20, 30, 40% in that scenario. And why does this exist? Because, I'm looking at the comments on Nick Timrose's tweet right now related to the CPI. He says that CPI came in milder than expected, which is a classic Timrose
way of saying I'm wrong.
Yes.
Notably, the anticipation was his.
But the comments from asset managers are just holding on to a belief. They're emotional, and you want to trade against those emotions. So they're saying, I still believe the overall trend of disinflation is stalled out, and this move in base metals blah, 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 will lead to accelerating inflation at some point this year. They say, is it still missing subcomponents? Core CPO, the data trends completely changed during the shutdown. Odd. People are not looking at the numbers. They're looking at what they think should happen. And somehow they're trying to, it's a heuristic. It's a bias. And it's a bias. You're anchored to your previous expectation. And that is classic finance 101, behavioral finance 101 of someone making a behavioral error because of a preconceived notion. If
you get in the ocean and you fight the current, you're more likely to drown.
Yep.
Because you think that you should swim as hard as you can this direction. That's how you get to where you want to go, and then you get exhausted and you drown. And that's what's happening with these people is they're unable to say objectively what is the world doing. Instead, they're like, what do I think is happening? Well, I think that Donald Trump is bad. I think tariffs are bad. I think that all this stuff is bad, and therefore the numbers should be bad. And when they're not bad, they're like, well, obviously because everyone is so bad and they're so bad, they change the numbers to fit their own narrative. When in reality, it's projecting. You're doing that. You're trying to change the numbers. So it's pretty telling, I think.
Yep. Shifting gears, Tom, sticking with just kind of on this Trump theme really quick. There's some hot button news items that I wanted to touch on. First of all, with Jay Powell, this story gets more and more interesting. At first, it was Trump kind of distancing himself, and then yesterday, Bill Pulte, who was projected was the guy who had actually fostered this move to go after and actually serve Jay Powell and the Federal Reserve, he distanced himself, saying he doesn't know anything about the subpoenas. It turns out that it was Judge Jeanine Pirro, the one from Fox News, who didn't seek a sign-off from her bosses at the Department of Justice before subpoenaing the Federal Reserve. She's defending herself, saying, we contacted the Federal Reserve on multiple occasions. They didn't get back. We never indicted them. It came out of Powell's mouth, no one else's. None of this would have happened if they had just responded to our outreach. Trump said, I don't know anything about the probe. Basically, what they're doing is they're backtracking a little bit on this Jay Powell piece, and I think some of that comes down to Bessent telling Trump, look, you're going to have a mess if you try to get Powell out.
Yeah, interesting. This is a messy situation, and there's a lot of data flying around. I mean, yesterday, I was just trying to take in everybody's view on this, and there are a lot of tweets and commentary that, like, man, the Fed is self-sufficient. They don't need government money, yada, 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 and they're independent in that way. But I think that people don't understand the relationship to the Fed and the Treasury, which is basically the Fed exists to facilitate the banking industry, and in exchange, they are supposed to use their balance sheet to help fund the Treasury. And right now, and for the recent past, that has not been the case. So the Fed has a $7 trillion balance sheet, and the idea is that they buy bonds and manipulate the bond market for the benefit of the Treasury, for the benefit of the people of the United States, their dual mandate, and that they are to make a profit, and those profits go back to the Treasury, which offsets the government spending. And in a typical year, they make between $80 and $100 billion on the balance sheet, and then they pay that to the Treasury, and that is a way of satisfying some of the government debt, or at least reducing the deficit. Unfortunately, right now, they've been running about an $80 billion deficit for the last 3 years, and that continues to accelerate because they've raised rates to a point now where they're basically losing money. They're paying more money out to the banks than they're taking in off their balance sheet. And the weird thing about that is that they basically put it as a deferred asset. So they're like, we're deferring this asset that we owe the Treasury. However, that's not how it works. What they're going to do is when they eventually become profitable, that IOU goes back to the Fed. So they're deferring that asset to themselves. So say I borrow $10,000 from Ben, I'm going to invest it and I'm going to pay him the proceeds. Well, I start losing money. I'm like, Ben, I owe you $100. And when I earn that $100, I'm going to put it in my pocket. So the question is the Fed truly independent and not needing of government money? The answer is actually no. They're supposed to be paying the government, and they're not paying the government. And when they get the money to pay the government, they're actually going to pay themselves. And so it's a very messy situation that Jay Powell has gotten himself into, to then be like, oh, I'm so super independent. Well, it's like you're only independent because they're not calling you on that debt. And the government, I mean, I suppose has the option to, and that would be even worse theoretically for the beautiful independence, the golden independence of the Fed. But they're losing just a massive amount of money. And if we're trying to reduce the deficit, well, Jay Powell's not doing a very good job of helping out with his part of that, his job to do that. And so the idea that the Fed, makes their own money, is independent, they do all this stuff, that's actually not true. We're actually subsidizing them in a big way right now. And that includes the massive amount of money they're spending to renovate their buildings.
It's complicated stuff. There's a lot of, like you said, data and news flying about it. But I mean, I think the big takeaway from my point is they're spending, and you pointed this out yesterday, Tom. They're spending a massive amount of money on this renovation, number one. And number two, it wasn't Bill Pulte, it wasn't Scott Bessent, it wasn't Donald Trump. It was Judge Jeanine who really threw this into an uproar.
Yeah, she thought she was being cute. And I think that where there's smoke, there's fire. But the problem is, do you want to fan those flames right now?
I think Trump knows he wants the rates down, and he's got to do everything he can to get those down. And this isn't going to help. Iran, they're going to get briefed on that later today. J.D. Vance and Rubio are presenting an options. Trump last night imposed 25% tariffs on goods from countries doing business with Iran. German Chancellor Friedrich Merz, who's had a little bit of a mixed start to his regime in Germany, says that Iran's regime is in its final days due to the mass protests. I don't know if that's true or not, but they do seem to be weakening. We'll have to see what course of action Trump ends up taking. In Japan, Sanae Takichi, she took the premiership role, the prime minister role, back in October, I believe it was. She's hawkish, and she's also big on the fiscal stimulus angle. Well, she has exceptionally high approval ratings right now, Tom, and it sounds like they're going to have snap elections either on February 8th or February 15th, which would be pretty significant because by all accounts, they're going to control Parliament if that happens because they're in such a strong position, which would really allow them to juice the stimulus. So you saw bonds weaken in Japan. You saw the currency weaken overnight, but the stocks just ramp, and that's going to continue.
I mean, I think that's positive for Japanese-U.S. relations. If she can really solidify power there, I think that's a good thing.
I agree. Also positive on U.S. relations, and this kind of gets to the point. I just wonder if Trump's being spread a little bit too thin, and that's why you're starting to see some of the issues happen with Powell and Janine Pirro, just losing a little bit of control because he's trying to do too much. But U.S. is nearing a Taiwan trade deal with lower tariffs from 20% to 15%, and Taiwan would commit to building at least 4 more chip manufacturing plants in Arizona. These plants cost about $20 billion each. They want to get this deal done certainly before Trump and President Xi of China meet in April. So that's what we've got on the geopolitical front. And the domestic front, a couple companies announcing earnings as we kick off Q4 earnings season. JP Morgan Chase reported earnings. Big thing there is Jamie Dimon, CEO of JP Morgan, saying the U.S. economy has remained resilient. Although labor markets have softened, conditions do not appear to be worsening. He's optimistic on the future with ongoing fiscal stimulus, deregulation, and monetary policy. They provided a favorable outlook for the year. That I thought this was good result, not outstanding result. I thought that investment banking was more likely to be a little bit an area of strength. It wasn't. It was actually down 2% on a year-over-year basis. But importantly, credit quality remains very strong at JP Morgan, and I would expect that to continue. At Delta, we'll talk a little bit more about this here in a second, but you've got a K-shaped economy going. Main cabin sales were down 7% in the most recent quarter. Premium products were up 9%. And they actually talk about this. They say they kind of boast about their 115% premium to the industry in terms of pricing. And they're really leaning into the international. They saw some growth on the Atlantic side. They saw some growth on the Pacific side in this most recent quarter. And they're going to buy 30 787s, which delivery isn't expected until 2031. But they're seeing good bookings right now, but it's a premium base. And we continue to see this K-shaped economy persist with the legs of the K widening.
I mean, it's not dissimilar to the $1 million house thing. The people who have money want to pay up for a better experience, and the people who don't, for the most part, aren't traveling. And so, I mean, never buy an airline stock. I mean, I know that maybe that's maybe not the best thing to say. I certainly have no interest in ever doing it, but we've talked about it a million times on this podcast. Delta fleeces people when they have the opportunity to, and then when they don't have the opportunity to, they fleece the taxpayer. And that's happened over and over and over again. The only winners are the executives. The only losers are the unions, the people who fly in the airlines, and the taxpayer. I mean, honestly, like, I'm not a big fan of nationalization of products, but I think there's only one solution to airline travel, and to make it we can all fly around on C-130.
It's pseudo-nationalized anyway.
Yeah, it is pseudo. Yeah, except it gets more and more expensive and less enjoyable. And it's just chaos. I hate airline stocks.
I mean, you see it, the load factor. I mean, Delta is walking away from business. They only filled 82% of their seats this last quarter. That's down from 84% a year ago. So they're walking away, and they're happy to do it because they're charging so much more on the premium products.
And I mean, listen, my dad was a Delta pilot. I churn my American Express Delta card so that when I go to the airport, I have a maximally enjoyable experience. I want
because the
to be
alternative
up
is so
front with the rich guys.
But the alternative is so miserable.
It's so miserable. And so, I mean, that's the only way to do it for me. I mean, we don't even travel that much, but we go to a lot of conferences. And every time I got an airplane, I want to be in the front and I want to go to the Delta Lounge and I don't want to be in among the people. And I mean, it is what it is because it's become so just absolutely soul crushing to be on an airplane.
I mean, it makes I'm not surprised to see the main cabin down so much at Delta because I flew Spirit a couple months ago, and for a quarter of the price, and I had exactly the same experience that you'd get at Delta main cabin at a quarter of the price. So
I mean, I've flown Ryanair before, and I would equate that to being what it would feel like to be in some sort of life raft. I mean, instead of 3 across, there's 4 across on both sides. You've got to Z your way through the aisles, and everything is hard plastic. There are no TVs. It's dark and smelly in there. I mean, that's the lowest cost airline, and man, it is grim. So that's the worst flying experience by far.
The founder must have started during the coal strikes.
It's been a while. This was 2016, the last time I took a Ryanair flight, but man, it is rough.
NFIB small business optimism data was out this morning as well. This is data for the month of December. Improved. The uncertainty index fell from 91 to 84 as the government shutdown ended. The outlook for business conditions improved from 15 to 24. But what's interesting is revenue actually decreased. And part of that is because price plans decreased from an index reading of 30 to an index reading of 28. What I think is interesting with the NFIB Small Business Optimism Index is a few things that fly in the face of a lot of what people are saying as we enter the year. The first is capital spending is not coming in quite as people think. If you look at capital spending on a year-over-year basis, expectations are that and I think we might even have a chart of this, Jonathan, at the end of the show notes. But capital spending is actually down on a year-over-year basis, and employment plans to hire are not especially strong. So what we're seeing is that people who have jobs are going to get paid better because they're bringing in more value, but for people to actually get jobs, it's going to be tough, as well as the capital spending. The reshoring piece is just not coming through as people had hoped. We're seeing a lot of capital spending on the data center side and a lot of equipment there, but we're not really seeing big plants constructed. And I've been talking to people in the industry, and they're not planning to do a whole lot. And now you've got the midterms that they're going to wait for. So I think that this big CapEx boom, we might see some of it due to AI, but I don't know if we're going to see the big plant construction like many people had hoped coming into the year. So we'll see what happens with that. But an improved number from the small business side, even though it doesn't necessarily mean stronger employment or stronger capital spending. Along those same lines, we have some news at Meta. Meta is hired a new president yesterday, which I think is going to be really good. Basically, she's going to go around and gin up funding for a lot of this infrastructure. They're coming out with a new platform called Meta Compute. So it'll be interesting to see how that plays out over the next few years. But perhaps the more interesting story that's not getting as much press is that they're revamping their entire performance review system. Top performers are now going to be eligible for up to a 300% of their base bonus.
I need to get on that.
These are people who are really, adding a lot of value to the company. They say.
Does this include the people who got the $100 million contracts?
It says for a small number of top performers who delivered, quote, truly exceptional impact. And I think this is what we're seeing. We're seeing increased focus. We've seen it at Amazon. We're seeing it at Meta. fewer employees, and you're paying their employees based on production, productivity, and value. And if you're not adding value, get off the ship.
I mean, we saw it's pretty much the exact opposite of what Meta was doing in the pandemic, which is hiring as many people as possible. And maybe that's the move. Maybe that's the new business cycle, which is you hire a ton of people, you give them 5 years, and then you just absolutely chop the heads off people who stink, and then you give that money to everybody else. I mean, it may be inefficient, and maybe we don't see another cycle like that, but that's going on all over this country. And I think it continues for the foreseeable future. And I think that's a net positive for GDP.
We're seeing it at Citigroup. They're laying off people. Announcement this morning. BlackRock made an announcement yesterday. They're laying off people. It's happening, and it's happening all over the place.
It's getting harder to hide with AI. I mean, you can replace so many tasks with AI. And if you're someone who just performs menial tasks or very obviously doesn't have production, or even if you say, hey, everybody's working at home, let's feed your productivity into the AI. Who stinks? Here are the 5 people gone. Here are the people who are above average. They get the money. And that just continues. I mean, I feel like if anything, the AI stuff adds the ability to quickly assess things like that. And I think we've talked about it, I think it's bad for unemployment, but I think unemployment has been artificially low for a long period of time. And I think we might get to a point where we might be above average for a period of time, but much more efficient.
When interest rates ramped up really quickly, I mean, I think the thinking was companies are going to be evaluating their best use of the dollar investment. Is it hiring? Is it capital spending? Is it investment in technology? And I think, is it partnerships? And over the last 3 to 6 months and accelerating into 2026, we're finally starting to see some of that, and we're seeing real impacts. Companies are looking at their dollar and trying to figure out ways to either save that dollar or ways to maximize that. We had Siri. Apple's Siri is now going to be powered by Gemini, and there's not really going to be a ton of money that changes hands. Gemini is going to get more users. They're going to be allowed to grow their platform, and Siri is going to stop investing tons and tons and tons of money in something that doesn't work. We have Eli Lilly and NVIDIA in a partnership to invest $1 billion in AI-powered drug discovery platform. This was announced just yesterday. This is going to be extremely significant and accelerate time to market and reduce costs. And they're doing this in partnership together. Eli Lilly's not spending billions and billions of dollars just, hammering the same spot over and over and over again. They're going to leaning on NVIDIA for that, and even Paramount, rather than just going over the top again for Warner Brothers Discovery, they're just suing them, saying, "Look, we're done with this. Tell us, you're in breach of your fiduciary duty." And so, we're better off spending that dollar on lawyers than paying you guys more.
Yeah.
And so I think that this theme toward productivity is something that is capturing the minds of CEOs. When they go into CEO executive meetings with their CFO and other leaders of Fortune 500 companies, they're going in thinking, what is that other company doing that's more productive, and how can I do that? Not, how are you guys attracting employees? That was the theme of 2021. Oh, how do we hire? I can't find employees. Now it's, how do we do more with fewer employees?
Speaking of themes, join us on Tuesday for the Narwhal Economic Symposium, which is our big annual macro event. We do macros every quarter, but this is the big one. We're doing it on Tuesday evening. If you're interested in attending, you don't have to be a client. I would encourage clients definitely to sign up and show up. Either email us at our personal emails if you got them, or TMMB, the morning market briefing, Tango Michael Bravo at narwhal.com. Forward invite. If you want to see the slide deck and you're not local, I'm sure Ben will send it to you. It's 142 slides?
Something like that.
So, but we'll be going over themes for 2026. You'll hear the boys speak live on kind of all of our thoughts heading into the year. I think last year's was really interesting, and we kind of followed those themes on the call all year. So I think it's a really beneficial event, and free food and drinks. Who could say no to that? And come high five the boys. So reach out to us if you'd like to attend. We'd love to have you. The more the merrier, and we will see you guys tomorrow.
Perfect. Subscribe, turn on notifications, share this with a friend. Always like to gain exposure that way. Thanks. See you tomorrow.